Hello, and welcome to MIT Sloan Alumni Online. Every month, MIT Sloan Alumni Online brings you the latest breaking news, cutting-edge research, groundbreaking ideas, and school updates from MIT Sloan faculty and alumni. Today, we have Jason Escamilla joining us. Jason is the CEO of ImpactAdvisor and Impact Labs. He has over 20 years of investment experience and has been a CFA charter holder since 1999. He earned his MBA from MIT Sloan in 2002. Jason, we're pleased to have you joining us. Would love to hear more about your work and some things we should keep in mind with regard to our year-end taxes. I will now turn it over to you.
Hey, great. Thanks, Greg. All right, everybody. Welcome to year-end. We got kind of the crunch going for year-end tax planning, but also hopefully we'll get a good sense, kind of give you guys a little, I don't know, wider view of the tax code in general, so you can kind of plan ahead for the future as well. But yeah, anyways, I run a wealth management company now and have a software company where we're building tools to, eventually automate a lot more of these things. But anyways, Impact Labs and ImpactAdvisor. So, all right, let's go. Let's roll into this. We got a lot to cover. So let me make sure I got my mouse working. Okay, here's your quiz, everybody. So federal budget deficits, we've been running them ever since I was at Sloan back in around 2000 was our last surplus. Anyway, so the federal budget runs October to September. So this year we're back to $1 trillion budget deficit, but with no crisis. Anyway, so if we were to take the next 3 years of budget deficits, question is, what would that exceed? A, B, or C? Total decades of credit card debt, decades of student loan debt, or A plus B? Well, guess what? $1 trillion a year dwarfs credit card debt and student loan debt. You hear a lot of people talking about it, but I mean, we're just running monumental deficits. So the reason I'm showing this to you is to get to a point where we think about, okay, there's a lot of tax incentives out there that we just can't afford as a country. So maybe you should take advantage of them while you can, that's what their purpose is. So back to our objective here. So let's look at some year-end action items. Let's try to point up some areas to think about so you can plan ahead on taxes, because I'm constantly hearing about people after the fact learning about an incentive that they missed out on, or, well, anyways, in a nutshell, too late, April 15th. And then also, ultimately you need to have a professional look at your situation. So there's a lot of information you can find online. Oddly, sometimes things are a little tricky, especially when the tax law changes and whatnot. There's a lot of great resources out there. I would love to figure out a way for us as a community to maybe share some ideas, because here's the deal. The tax code is designed for everybody. Kind of like when you go to the DMV or the driver's, get your driver's license, it's like all walks of life in there. And it's like, it has to apply to everybody. So like we have a lot of things in common as MBAs and grad students from Sloan undergrad that, I don't know, we might be able to kind of make a more sort of targeted and potentially useful idea sharing, but I don't know, I don't have a solution for that. So anyways, bottom line is I'd love for us to kind of help each other out and share some ideas or figure out a kind of an easy way to do that. So if any ideas, share them. I did post a link to this on the Sloanies Helping Sloanies Facebook page. So, I don't know if it's a perfect forum yet, but somewhere in there is a way to kind of, share some good ideas. So this webinar is about me at least trying to get as many of the things I've learned over the years to share with you guys that might be relevant to a broad base of, of MBA/grad student, PhD, undergrad, MIT alumni, community. So here we go. And moving forward, there's a number of myths in tax reform. It's obviously a very heated discussion. Maybe I can just show some facts and hopefully simplify it for you, because ultimately I want you guys to be able to make, the right optimized decisions for yourself to improve your impact. So here we go. So let's try to put a little bit of focus on this, because again, it's such a broad subject of taxes. But bottom line is we're all alumni. We applied to school. We spent money, maybe built up debt, and then we start earning, which kind of puts us into a different segment. Part of that is deciding where you're going to earn. You know, you got Apple opening a new campus in Austin, Texas pretty soon, or they announced it. So there's no state income tax in Texas. You know, if your goal is to save up to buy a house or whatnot, maybe I want to kind of get the numbers in front of you so you can think about, well, maybe you should move to Texas. Maybe Amazon up in Washington State is going to get us to our goals a lot faster versus Cupertino in California. So anyways, taxes are high. You have a lot of choices. Even as a wage earner, you've got the timing of your stock and option grant. So there's a little bit to kind of get in front of there. And then of course, when you go the entrepreneurship route or even just do a consulting gig for a while, I've had a number of people tell me they didn't realize how much they could save of their income in their consulting gig in retirement and defer taxes. They didn't realize that until a year or two later. So, let's get in front of that. And of course, we plan to build wealth and ultimately retire. So there's a lot of smart moves you can do as well on the wealth and retirement planning. That's my background. Before Sloan, over 20 years ago, I worked at a money management firm, and out here, especially in California, the cost of the tax rates are really high. So we'll show some examples, but taxes are your number one investment cost once you kind of correct for weird decisions and whatnot. There's ways your expenses can but you get crushed on taxes if you're not smart. And you do have some choices there. Ultimately, on to sort of the number 6 here, the giving back side. Let's go to the next slide here. I'll go into that some more. So I don't know, when we were about to graduate in 2002, I remember Dean Schmalensee, pulling groups of us together, and Dean Schmalensee was our dean at the time, and he thanked us for our tuition dollars. And he did kind of point, we like numbers, and he pointed out, like, thanks that you covered half of what it costs to get you this far. So fortunately, there have been many people generous before and after us to kind of keep that going. So if you're thinking about giving back to MIT, there's a smarter way to do it than just cutting a check, and we'll get into that. So by the way, there will be some time for questions, so feel free to send those in as well. But let's see how quickly we can move ahead. So previous slide is you have your stages of life, you have your goals you're trying to get to. The IRS has created tax incentives. Some call them tax breaks, some call them loopholes. But bottom line is, like, I don't think we can penalize MIT alumni for wanting to optimize, especially this category. We all know how much we pay in taxes. So you might as well sort of, keep a lookout for where the government has decided to give you incentives or tax breaks or tax loopholes. Pick whatever you want to call it, but let's figure out how to make the best of them. So, everything from investing and startups on the business creation side, there's ways to set up your company to be much more favorably tax-wise, much more favorable tax-wise. There's some amazing retirement state. Like, I just found out, I didn't even know about this one. Like, we focus on the high net worth folks, but if you're fairly low income, like didn't make much money, like maybe you just graduated and you're traveling a little bit or working for a nonprofit, there's up to a 50% tax credit on the first, I think it's $2,000 that you put into an IRA when your income is low enough. So you get tax benefit for putting it in there. You actually get paid to save. It's amazing. Actually, one cool thing about tax reform that a lot of people don't know is the child tax credit you get a $2,000 tax credit if you're single and make up to $200,000. And if you're married, it's up to $400,000. So basically what that means is, after tax reform and after the way they've restructured the tax credit, if you have 3 kids and you're married, you don't pay $1 of federal income tax until you get up to about $80,000 of income. So there you have it. A lot of tax breaks on philanthropy. Again, I mentioned the low income stuff out there. We don't have time to go into that, but I thought you might find that interesting. But anyways, the question is, how much longer will these exist? There's a lot of misinformation about on the homeowner tax benefits. It's still probably the largest, that the homeowner tax benefit is probably the biggest factor of the haves and the have-nots of, say, my parents' generation. Like the ability to have had, well, anyways, we will go into that as well. It's huge. It's still massive, and there's still a lot of reason to align your goals with some tax incentives, or hopefully not forget about some of the tax incentives out there. So moving ahead here. So let's come up with an example of aligning a couple of goals with some incentives out there. So let's say you 10 years ago bought a share of Amazon stock. I mean, the stock is still up. It's nearly doubled in the last 2 years, approximately. If you bought it 10 years ago, it's up like 15x. So it's a good day today, maybe anyways, 15x. So bottom line is maybe you want to reduce your exposure to Amazon. Well, if you live in California and you have a decent income, you're looking at, so your share of Amazon that's worth $1,500 today, a little bit more, is after taxes, you have about $1,000 left. And yeah, that's long-term capital gains tax rates, believe it or not, in California. So what else can you do if you want to, again, reduce your investment exposure? And maybe you're thinking about some of your other goals with respect to what Dean Schmalensky talked about. Maybe there's, anyway, so impact, donations, philanthropy, your kids are in private school, you name it. So instead of selling your Amazon shares and paying the, in the range of $500 in taxes in this case, you could donate the $1,500 of Amazon to charity of your choice. The charity, so MIT gets the full $1,500. You get actually to take that write-off, which in the right circumstances can be, in this case, I got a $690 tax benefit. So I'll show you an example on a tax calculator where that gets that way. If you live in Texas or Washington State or Nevada or Florida, you don't have as high a taxes, so things will be, the numbers will be a little lower for you. But what I want you to do is think about combining goals and some of these tax incentives. Another one that a lot of people miss is the corporate matching. So, if you work for B of A, Deloitte, Goldman, a lot of these, they'll match up to, the first $5,000. So in this example here, where you thought Amazon was kind of getting a little high, and I recommend adding a 0 to all these numbers. But I did one share because it works great on the corporate matching. So you donate, MIT gets $3,000. Instead of having $1,000 after tax, you have a $690 tax benefit. So you gave up $310 in this case for MIT to get $3,000 if you had corporate matching. So anyways, that's kind of the idea of combining goals, but there's some mechanics and timing of things that a lot of people have questions about around year end, about standard deduction. So we'll try to cover some of that a little bit. Now I built this tax calculator to attempt to simplify the tax decisions like this. So let's flip over there and let's do a couple of quick examples to try to highlight some of these key points here. And I'm going to punch it into the. Oh no, you guys got the URL here. We'll just pull right in here. So I'm going to switch over here. All right. Now, I'm going to assume you guys can see my screen here. So.
Yes.
Oh, thanks, Greg. Okay, great. So you guys, I don't know, those numbers are kind of unbelievable to some people. So this calculator is for California and federal taxes. And just to kind of give you the scope of it, you guys can play around on it if you want. But the point is, if you are single and make, some nice, MBA type wages in here, and you got nothing else going on, you don't own property. In fact, let's make it even simpler. Let's say you do have a mortgage and you have a little bit of property tax that yes, you can't write it on federal, but there's a little bit of a tax benefit in California. So in California, if this is you and you donate another $10,000 somewhere, you get 45% cash back on your taxes. It's great. Here's another way of looking at it. If you are thinking about selling those shares, now if we add, let's see, I think we put a 6 in here, your long-term capital gain, those Amazon shares. So those are, so you take a $10,000 gain in your Amazon shares, you're giving up 36 cents of that. So I don't have enough time to go too deep in this calculator, but I wanted to show you sort of how to use it in case you cared. Because what I've learned is everybody's different, and maybe you're married, maybe you have kids, maybe you don't have kids, maybe you're in a high tax state, maybe you're not, maybe you're thinking about philanthropy. If you can just pick kind of the one that matters for you over here. You know, there's a medical expense, like medical expenses this year. If you've had a lot of medical bills this year and next year, if you can jam those in before year end, you get to take the write-off this year, and then you won't get to write them off as well next year because there's a 10% AGI limit. Anyways, I could go on forever here, but this calculator is it's just kind of a way to take, like, what are the pieces that matter? Your wages, you're self-employed, you have investment related income, or over here you have things like business income, you have an S Corp and LLC, alimony, Social Security. These are the basic income categories here. And over here on the deduction side, and I'll tell you, tax reform did dramatically simplify things for people. But we're gonna get into the whole standard deduction issue for you. But you know, some buttons over here, you got, like if you are in California and this is your scenario here, tax reform, this is what living in California does. So this person needs to have made, in order to be in California at that income level, they need to be making this much more to have the same net income. This is how much more they pay in California at that income level. That's the California tax hit. You know, New York's kind of probably similar. It's up there. There's different things that are kind of move around. You've got, you know, there's this homeowner tax break over here. You can punch this in. So in this scenario, this person with $25,000 of mortgage interest and property tax that's not really deductible, you know, they got a $9,000 tax break. Like they're saving that much in taxes because of the way the tax code is. And by the way, there's a whole capital gains exclusion. So if they move and sell their house and you're married, I mean, this is massive here. Like when people talk about the homeowner tax break and the haves and the have-nots, like I think about my parents being able to have taken up to a $500,000 gain in their house when they sold and moved and pay zero tax on it. You do that a couple of times, you've created several $100,000s of extra money for retirement. I mean, even first-time home buyers can get a mortgage interest credit if your income is $175,919 in San Francisco. I mean, there are some massive tax breaks out there, folks. All right, so yeah, you can check out the homeowner tax credit. You know, by the way, one of the myths, if this person were in federal only, Nevada, Florida, their tax break was $8,500, and if they were in California this year, their tax rate again, $8,800, it's even higher. So there's a lot of sort of misunderstandings of kind of the mechanics of the tax code and who got hurt and whatnot. But by and large, most people came out ahead really nicely. You know, there's another, you know, here's the, actually, no, let's just roll down here. Marriage tax break, that's kind of a fun one. If you're, let's say you just graduated from Sloan and so your wife's been kind of supporting you there. You got no other write-offs going on. You're thinking about getting married, your fiance, you're thinking about getting married in January. Well, let's see. In this case, say married tax break. In this case, if you get married before year end, you're going to save $27,000 on taxes, in your taxes. Just kind of how it works. Happy to explain why if you guys got more questions about that. Bottom line is, like, if you're smart about when you're making certain decisions, you can optimize. So, all right, let's see. So I think I showed you, you can punch in your income here and see your long-term capital gain tax rate. Right here, you got short-term capital gains. So the difference between those two, again, you're selling, there's a big distinction on your so capital gains, think of it this way, is you essentially profited from investing. And if you held it for more than a year, you get a much lower tax rate. But other things come into play when you factor in if you start making, sort of MIT alumni type money. You've heard of AMT. The alternative minimum tax is higher. So depending how that can work out, it can be, pretty high. So let's take another example where long-term capital gains can be significant. I think it's pretty good if you go about 350 single, and you already, you got some investment property already. You're looking at selling some investment property. Maybe you already have a mortgage in another place. You're looking at selling investment property and taking, say, $1 million gain this year. So what does that mean? So again, I'm going fast, I'm sorry, but you can tinker around. Point is, here's your situation before, and here's what you're thinking about changing, and you want to just focus on one of these. Let's look at a long-term capital gain. So 39%, like there's no country in the world that has long-term capital gains as high as 39%. It's massive. So you sell your property or whatever you have that has $1 million gain, it can be Bitcoin, and you're giving up 39% right out the gate. You combine a long-term gain with philanthropy, other things come into play. We'll pop back into the slide deck, and you have some other options sometimes in these scenarios. So let's just see what we can do to try to cover some of those. Let's see, what did I miss here? You got the mortgage benefit down here. This is where you can put in medical or your 401k contribution piece. There's something called the pass-through deduction. You'd want to kind of put it, it's really complicated to know with certainty. You have to spend a little time to know with certainty, but this is where you put that in here. So, all right, well, let's move ahead on, let's go back to the slides now. Let's see, so I think this is where I asked Greg to bring us back to the slides. All right, thanks, Greg. Okay, so there's a calculator that possibly can help narrow like your focus on maybe what matters or help calculate things. But what we're going to do now is kind of scroll back to the slide deck and kind of try to get back to our objective here. So I think I just need, there we go. We just need the next deck. Okay, so here's probably the #1 question that people have. Your deductions, standard deduction. So if you're single, it's 12,000. If you have a child and you're single, which had a household, it's 18,000, and it's 24,000 for married. I added this graphic and covered it up. So what that means is you get to just deduct that out of your income before you figure out your taxable amount. Now, it used to be lower and used to be able to add some other deductions in there. So what, we've all heard about, the homeowner tax benefits. That goes back to the mortgage interest piece. The mortgage interest hasn't changed if you didn't move. If you didn't move, nothing's changed for you. You get, you could have you could have had a mortgage up to $1 million that the government helps essentially subsidize for you. But the problem is when you get into that scenario I showed you before, where you standard deduction versus itemizing. And so let's just break it down. You're either single, you have a kid, or you're married. Okay. If you're single, it's $12,000, and then there's 2 more that you get for free if you don't have any other write-offs or deductions. If you're married, it's $12,000. You get your local and property tax up to 10, but it's capped at 10. So you got a $2,000 hole there. If you're married, you get a $24,000 deduction, and you still are capped at 10. So there's a $14,000 just kind of hole, which simplifies your taxes. You don't have to think about things. But what it also means, if you make a donation or have some mortgage interest, you don't really get a tax benefit from it until it gets you up to where the combined amount exceeds 24,000. So what that means is you might have some year-end optimizing to be done. let me give you an example. So a buddy of mine paid off his mortgage this year. He's also a Sloanie. He has a kid in private school, and so he's married. So next year he'll have he'll have 10,000 of his local, you know, property and income tax, but he won't get to 24. So his next 24 or 14,000 of donations there's no tax benefit. Everybody gets them. So what he can do is this year he can load up his donations now while he's already exceeded that limit. So he gets dollar for dollar write-off. So the recommendation I had for him was to either donate now to MIT, to schools or whatever, or, and by the way, use appreciated securities. Going back to that Amazon example, you have to have held it for 1 year. Just ping me, I can give you more info on it later. But the other cool thing that's out there is what's called a donor advised fund. So you can take your donation this year, you can donate, up to some various limits, but it can be up to half of your AGI or 30% of your AGI, depending your adjusted gross income, depending what you're donating. But you can, okay, so I guess what I'm saying is, if you are thinking about the tax benefit of donating, you're already at the dollar for dollar this year, or maybe your corporate matching, maybe it ends its calendar year. Some corporate matching is fiscal year. So you want to kind of max out your corporate matching. Some corporate matching, anyways, so if you want to kind of load all that in this year, that's one example. But in this particular case, he pursued what's called a donor advised fund. So what you can do is you can go to a brokerage firm. Our clients are at Schwab. There's also Fidelity. Those are the two big ones for donor advised funds, but there are many out there. And what that is you can donate into that fund. It's irrevocable donation that you're making. And you can, it'll just, put it in an index fund or whatever. And you can actually just log in and send checks to your charities over time. So, but you get the write-off this year. You get the tax deduction this year. You may not get the corporate matching credit until you make the deduction, if at all. But that's something you want to look up. And actually, a great resource for your corporate matching is doublethedonations.com. Again, like one-for-one matching at a lot of these places. All right, so another thing as it relates to the standard deduction is AMT. 29% of people making kind of MBA type wages in last year were AMT payers. The AMT limits and things, and I won't go into the exclusions and the limits, but they got bumped up. So what that means is you don't have to worry about AMT. You have to calculate. You don't have to. AMT does not mess up these calculations. It doesn't. So what that means also is, tax reform helped you if you're an AMT payer. Why? Because you still get $10,000 of your state and local tax write-off that you did not get under the AMT calculation. So one of the myths out there. Anyway, so let's keep moving to try to make sure we're covering a broad audience. So there's another thing, if you're an international alumnus, it's pretty cool. If you're in the UK, you can make a donation that gets to the Dean's Fund and get matching in the UK. I think it's 1-for-1. Ask for that. Ask your classmates overseas if there's other programs like that. If you're 70 and a half years old, you can donate. I know we're not there yet, but hopefully this one will stick around by the time we get there. But for those of you who are, you can make a donation out of your IRA and not only be able to get your standard deduction of the 24,000, say if you're married, but pull it out of pre-tax money. And it qualifies as your RMD, your required minimum distribution. So if you're that age, you know what I'm talking about. Donor advised fund, really cool. It's a way to take appreciated securities today and get the full write-off. Remember that Amazon example? Get the full write-off today before the tax law changes, before your income, maybe your income's going down next year, whatever's going on, get the full write-off today and then just kind of send the checks out when you're ready to donate. There are some other interesting aspects on that where I talked about corporate matching. Actually, another thing is, a lot of time your spouses have corporate matching, and maybe, a spouse can donate in their name and give you credit at MIT. You know, it's really simple. You know, look into your spouse side as well. Exotic securities is kind of a fun one. That's where, so sometimes when you donate assets that are kind of a little, you know, maybe a private company, or there's an aspect where if there's leverage, if there's a lot of borrowing inside the asset, it's a little more burdensome for the nonprofit to receive it. But if it's a big enough donation, sometimes they'll cut a deal with you. Well, you know, you're donating $1 million piece of property that's heavily appreciated, and you're, you know, again, kind of like that Amazon case, you're sticking them with a little bit of taxable, you know, basically it's taxable income that the charity will take a hit with, but they might cut a deal with you to kind of happily take that gift. You get the full write-off, etc. They get the full benefit, and they'll eat a little bit on tax. You know, don't forget about picking up the phone and talking to the folks at MIT about some of these exotic security options. Shareholder remainder trust, I'll let you look that one up. That kind of works when you're a little bit older and you want to get a little income off that. But again, it's in the interest of time, I'm going to move forward, and you know, feel free to ping me on those as well down the road. All right, so 2018 considerations. So here's what you need to do to optimize for this year. You need to look at what's changing in your life. Whether, you know, on my tax calculator, I broke up the different buckets. You know, the number one thing is capital gains. You know, that's where you come into, a lot of people, especially out here in the Bay Area, a major part of their compensation is in the form of stock. And, you know, again, you need to talk to a professional before you pull the trigger on this stuff. But, you know, the things that you need to ask about is, you know, you can actually control some of the timing of some of those gains. And basically think about capital gains, you oftentimes have control of the timing of it, I guess is what I'm saying. And that's where you can kind of pull gains forward now through your investment portfolio, maybe because your income is going to go up next year. Or you can delay and defer, and then that's an example of not selling something and continuing to have the risk on. You know, you've also got some other things. If you started a business and have some income, you know, a lot of Sloanies go from being a W-2 employee to, I mean, as a business owner, you're highly incentivized to save for retirement. If you created a company, you can make a solo 401k. And if you didn't create a company and you're just doing your, you know, like a consultant as a Schedule C, so you didn't have to do all the infrastructure, you have things like a SEP IRA option. And depending on your income level, you can get into like the mid $50,000 of income that you can put into there and not pay tax, you know, defer your taxes on. Especially important when you're married. You know, when your spouse is screwing up your tax rate for you, making it really high, makes it really expensive to start a business. Anyways, we talked about the marriage benefit. Again, it's just the tax code has to you know, make the call. Like, you have dual married people, and then you have some where one of the spouses at Sloan not making money and the other one's making all the money. And then how do you balance out the tax rates? You know, IRS had to make the call. When you're deciding to get married, you also get to make the call whether it benefits you or not. So that's really what it comes down to, is looking at the itemizing options you have. There's another aspect in California. People have already been invoiced for their property tax. So there's the idea of paying it now. You might get a little bit of a benefit on your California return for paying it now. Again, talk to your tax advisor, but you know, your property tax, your state and your local, that's capped at $10,000 per year. So, you know, look at where you are on your for sure deductions. Look at, you know, the standard deduction that you get without even having to think about it. And then look at how things are going to change next year, and you know, kind of play around with the different buckets, meaning donate more now, or as a business owner, you know, maybe there's some expenses you can pay to modify your income. Lots to think about there, but let's try to move forward to the questions here. Oh no, sorry, this is a good one. This is a fun one. Back to starting a company. So this also is a lesson in how quickly the laws change. So there's a beautiful thing in the tax code where if you start a company and you sell shares of your company, every shareholder gets a $10 million tax-free gain if they've held it for 5 years. If it's a qualified small business, meaning it's generally mean it's not a services business. Again, I'm just telling you kind of the things to ask your tax professional to look into. But when you're thinking about something like this, where you're issuing shares, starting the clock 5 years, look into this one. This doesn't work for services business, and it kind of parallels something that you guys might have heard. For those of you who are business owners, you might have heard about the pass-through deductions called the Section 199A deductions. It's amazing. That becomes a consideration when you're starting a business now. So yeah, business structure, taxes were always a factor, but they became an even bigger factor after tax reform, like less than a year ago that was signed. You know, then you get into on the fundraising side. There's a lot of people don't realize, but you can actually invest in private companies with your IRA, which is to say with money that you didn't pay tax on. You paid some Social Security tax and Medicare, but you didn't pay income tax on that yet. So pre-tax money can be used to invest in a self-directed IRA. So that's what you want to search on the internet, self-directed IRA. It's an interesting one where, you know, that you can maybe put different share classes, and maybe on the one hand, a friend of mine had some invested in a company. There was part of it he did in his Roth IRA. The Roth is the one where you, by all promises of the government, you'll never pay income tax on that money again. So so you have the tax-free piece, and then the other piece, which is your IRA money. You know, there's creative ways to structure things so that you are not limited with your retirement on how you invest. And then on the other side, if you're raising money, you know, there are ways where you can allow your investors to use their IRA money. Again, it's you know, for accredited investors, generally speaking, that's where I've had experience with that. I know of a custodian who facilitates that. They require 10 shareholders minimum. It's really easy though, surprisingly easy. And then the challenge with that when you own something through your IRA is you just want to make sure that custodian stays in business. So if that custodian goes into trouble, you run the risk of having to kind of eat, you know, pro rata among everybody, whatever the downside of that custodian was. So, you know, those are some things to think about. All right, so then, all right, back to another Sloan alumni goal here is wealth management. So, you know, we're accumulating wealth, and this is my business here. This is tax efficiency. So we do passive investing, and we focus on tax alpha because, again, that's your number one cost over time is the tax hit. So for for tax alpha, think about asset location. So this, backing up a step. So if you think about income you get from an investment, if a corporation is paying you interest, i.e. corporate bonds, that's a tax write-off. That company got a tax deduction for paying you the interest. So when you receive that interest, you have to pay the full tax rate on that, like your highest tax rate. If you held shares in the company and they paid you a dividend, that's after the company had paid tax. So that's capital. So qualified dividends are at a lower tax rate. So again, there's different tax rates because, you know, one of them, the company got a tax write-off, the other one they didn't. So if you know, it makes sense that they're different tax rates. So maybe you want to think about like which your IRA holding one thing, your Roth, maybe, you know, if you have a corporate bond part of your portfolio, you know, you don't want that and you have a high tax rate, you don't want that in your regular brokerage account when it could have been in your IRA. Because you know, we didn't go too deep on the tax calculator on those tax rates, but they're massive, like 50+% in California. I imagine it's pretty close to that in New York. So 50+% of your bond interest means you lose half, and you got to beat inflation. So, another thing, like with U.S. Treasuries, there's no state income tax on Treasuries. They can't tax that. So the 10-year Treasury is paying, I think, 2.85% per year. But if you're getting taxed on that at the federal level, you're not beating inflation. So anyways, there's a lot of important things to consider with taxes. And by the way, even if it's in your IRA, you still have to beat inflation and you still have to pay tax. So you just have to do it later. And, we didn't drill too much into the tax, into the urgency of how taxes are going to change. They're going to get worse for us. Meaning if you're earning money, we will need to pay a larger share of our income over time. Our $1 trillion budget deficit today, this current fiscal year, $980 billion on CBO estimates. You can see some links on that tax calculator. $1 trillion, that's 1/20th of our whole GDP. So $20 trillion GDP, our government's given out 1 trillion of non-taxed, tax breaks. That's a 5% of GDP stimulus is what I call it. So we can't, that's not sustainable. The tax rates have to go up and these tax incentives have to go down or some combination of it. So, think about that as you plan your investments and plan over the long term. For example, you get things like on your capital gains, you can, there's timings of what you can do. You can take some long-term capital gains when you're in a lower tax year. Long-term capital gains are a great treatment. You can look at them on the tax calculator. They actually start out at 0 and they go to 15% and then 20%. Once you start making, over $200,000, but, then they kind of factor in with AMT at some point. So again, I realize it's not a simple, clear explanation, but everyone has such a wide range of a background. But another thing, 1031 exchange is a concept where you can sell investment property and you exchange it into a like kind, another piece of investment property, and you get to sell it and not realize the gain. And why that makes sense is for anyone who sold real estate property, there's so many transaction fees involved. So it actually kind of makes sense to let people kind of rotate, their assets around and pay everybody in transaction costs. But there are thoughtful ways and some options you have around that with investment property. You used to be able with Bitcoin. Last year, tax reform took this away, and it was a little bit unclear in the tax code, but you could exchange your coin, one coin for another coin. There were companies helping you do that were sort of vouching for it. But again, you need to get your CPA on board with whatever you do. This is just at ImpactAdvisor. What we do with my company, we build companies from scratch. So we'll have 50, 100, 150 stock portfolios. We align them with your values. What that means is we can be extremely tax efficient. So around year end, we can pick and choose. If you held Amazon for the last 2 years, you're more than double. If you do any kind of philanthropy, you want to integrate your investment portfolio in there. All right, I think we want to kind of whip ahead over here. On the stock bonus piece, specifically, kind of the simple way of thinking is figure out which part of your RSUs or your ISOs are capital gains, and think about, some aspects of that you can defer. For certain types of stock compensation, I think some of you guys know this, but if you got it more than 2 years before you sell it, it goes into the capital gains bucket, part of the gain. And again, it becomes one of those things that you could donate. You could potentially use it to invest in Opportunity Zone, which I don't have time to get into, but that is a whole nother boondoggle that got created with tax reform. Again, who knows how long these things will last, right, in the tax code? But these are things to think about. But yeah, when again, all aspects of your goals in your life, think about what you want to do today and in the future. Look at your tax rates. Look at what things you can move around, and those are kind of the quick ways of thinking about the leverage you have. If you're a business owner, you started a business, you have like an S corp or LLC, you have a solo 401k, there's a lot of things you need to do before year end. If you're a sole proprietor and it's a SEP IRA, you can actually play a little catch up before you file your taxes. But anyways, again, you guys got to seek a professional before making any decisions or letting the clock wind down. And I think I'm gonna turn it back over to Greg.
Great, thanks, Jason. As a reminder to our participants, you may type in your questions in the Q&A panel in the Zoom interface. And while you're doing that, I'll take a moment to tell you about a few upcoming events. On January 31st, we will have our next Sloan Alumni Online presentation by Professor Paul Osterman, titled "Who Will Care for Us? The Coming Crisis of Long-Term Care." You can register on the MIT Sloan Alumni Online website, where you'll also find links to previously recorded sessions. You'll also find the upcoming lineup of events for the spring. So we do have some questions that have come in, both from the pre-registration and live. So we'll start there. Jason, what are the new rules for the deductibility of charitable contributions? So can you say a little bit more about that?
Yes. Well, the good news is the deductibility has not gone away. The part of where the confusion comes in is that people get a free deduction by virtue of the standard deduction being bumped up. So yeah, if you were thinking about anything philanthropic wise, really the only optimization is you have to donate more before you actually get an additional tax benefit. Because again, if you're married, you get a $24,000 standard deduction without having to have done anything to help improve the world, other than working and otherwise paying taxes. So yeah, it's good news. But it also means that you might want to be smart about how you time things if you really want to maximize the incentives.
Great, thank you. And of course, some of these questions get quite specific to an individual's own circumstances. So as you said, we encourage folks to consult their own tax, legal, and financial advisors before taking any action on these. But one question is, let's say I receive a year-end bonus. What are some ways to offset the tax implications of that bonus?
All right, well, so that means you get ordinary income coming in, and there's some exotic stuff out there related to land conservation and whatnot. If you want to pay taxes like a billionaire and you're accredited, but when it comes to thinking about if you were to think about like your tax rate and something like that can oftentimes that really opens up philanthropy. You definitely want to max out your 401k, IRA. If since it's a bonus, it sounds like you don't really have. You probably already thought about that. If you're over 50, you can do an extra $6,000 in your 401k. So remember that if you turn 50 this year. And then on the IRA side, if you don't have an employer-sponsored plan, you get an extra. I think your IRA max goes from 550 to 6,500. You get an extra 1,000 in there if you're over 50 for your IRA. Again, IRA deductibility depends on whether you and or your spouse are in an employer-sponsored plan. With that, we'll go on to the next question.
Great, thank you. What major impacts will the new tax reforms have on personal investing and finances?
So again, not a lot of changes in this case. And it was like this time last year, we weren't really sure how it was going to play out, especially the way we build all these investment portfolios to be extremely tax efficient. But the biggest one is opportunity zones, where you can take your capital gain only and invest that into an opportunity zone, which is an area designated. There's hundreds or whatever designated areas in the country where if you investment stays with them for, I believe it's 8 years, well, if it stays, put it this way, if it stays there for 10 years, you permanently avoid the tax, that capital gains tax. It's crazy. But again, like we're running such amazing deficits right now. Like on the one hand, opportunity zones are new, and kind of rush to market, there's probably going to be better investments down the road, but maybe there'll be more competition for people trying to get in. That's the newest one that came. The rest is just the same old stuff. I mean, it's great. It's like you know, in California, your long-term capital gain tax rate is actually higher net. So it's more important to be smart about that. But no, there's, you know, there's some at the corporate side that they're going to shift away. I mean, well, anyways, you know, let's try to kind of whip through. But the bottom line is like, it was a relief that nothing changed for my business, and yeah, I don't have a lot of great examples for you on the change. Everything is on what's all the smart way to invest, which I kind of danced around. But
one question that came in from our live viewers, can you donate appreciated shares into a donor advised fund and get a deduction for the full amount?
Yes, there's a typical limits you want to double check on, but yeah, the full amount that you would have gotten, it's equivalent to having donated to MIT. Again, corporate matching sometimes doesn't recognize into a donor advised fund, but they'll recognize it if you give it to MIT. Maybe they'll wait until you go from donor advised fund to MIT. But yeah, it's a great place to park. And when you're at like for our clients, we can actually send a fax in by midnight, and they get the tax credit of their securities. You know, but keep in mind you have to hold it for a year. Speak to a professional before you pull the trigger. But that's the beauty of the donor advised funds. These guys are experts at it, and they got great helplines. You can just call them. Schwab, Fidelity, those are the biggest. You know, happy to help you out if you got some more questions on that.
Thanks, Jason. So one question, can you claim a deduction on MBA tuition if you change jobs and industry?
Great question. You know, we had a guy, CPA, come and do presentations at Sloan when I was there, 2000, 2002. And he wrote the opinion that I could take that deduction. You know, I was at a money management firm where we did sustainable investing, tax optimized investing before Sloan, and kind of was going sort of back into that field, so to speak. I actually got audited. And I went in, and so my CPA signed, and he thought it was fine. But anyways, I went in to the IRS here in San Francisco, and the guy said, well, we can do this. He had me read a line in the tax code that he thought that I was violating the way I filed. And he said, we can do this the easy way or the hard way. You can pay this fine, and how many tax years were you at MIT? And then, or he was going to look at more tax returns. So I just paid it, moved on. So I think there's a little bit of gray area in there, and it's not clear. And in my experience, it was not deductible. So check it out. Ultimately, your CPA needs to sign off on your taxes. So good luck with that one.
Thanks, Jason. So one question that came in, you know, and this is maybe getting a little specific, but maybe you can extrapolate out from there. But I'm 72, retired with investments. What's the best strategy for dealing with considerable unrealized capital gains?
Wow, that is a phenomenal way to help the cause over at MIT. But anyway, so we already covered you know, the donating piece and doing it in a year when you're in a high tax bracket. You have, you know, if you're, let's see, when it comes to appreciated securities or assets and you want to sell one and move it into something, it has to be a like-kind exchange, and they dramatically eliminated the like-kind options in tax reform. You used to be able to do a cow for a cow, but a female cow, but not a steer, a male cow for a cow. You know, like it was actually there's some fair flexibility. That's gone now, just real estate. Used to be able to do it with Bitcoin. So yeah, I mean, you have the ability to, again, you can look at the math on from before on that Amazon example, and if you're in a high tax bracket situation, and then otherwise you want to look at being able to realize capital gains and staying under, if you're able to pull it in when you're in that 0 tax bracket window or the 15% tax bracket window, it's a great place. You can tinker around on the calculator or just look up the tax rates on that.
Thanks, Jason. I think we're going to do one more question, but you mentioned Bitcoin briefly there. So one viewer has asked, so I've profited in Bitcoin. What are my options? Is Bitcoin treated as an asset?
All right. Well, I believe the IRS came down on that, calling it an asset, but it's a little, the SEC's got their. In fact, the bottom line, if you profited, that means you sold it already, and you have tax due, in your estimated taxes. If you did not sell it yet, sorry to hear that. It's been a rough couple of weeks, but yeah, you don't have, you've already sold it, and even if you hadn't sold it yet, last year I saw how the donor advised funds were accepting Bitcoin and some other, maybe just Bitcoin and Ethereum last year, but the cutoff date was pretty early in the year. You might be able to pop it into a donor advised fund still. I'm not sure. Check that out at Fidelity or Schwab. Otherwise, if you sold already, you're out of luck. Sorry to say. But there, you can look into other tax alternatives. Check out the tax calculator. There's a land conservation piece in there, which is a little funky. That's a little tricky, but I'm happy to walk you through something like that as well. If you just hit me up, offline. j@sloan.mit.edu.
Great, thanks, Jason. We'd like to thank you for joining us for this edition of Sloan Alumni Online. I want to thank all of our viewers for joining us as well. To keep this conversation going on social media, please use the hashtag #SloanyChat. We do have a disclaimer. So this webinar is being provided to you for informational purposes only and should not be relied upon for tax, legal, or financial advice. The material in this presentation is based on some reasonable factual and legal assumptions, but does not contemplate consideration of all facts and circumstances of each individual situation. MIT ImpactAdvisor LLC, Impact Labs Inc., and its affiliate online services, therefore, do not warrant and hereby disclaim any warranties, either express or implied, with respect to the accuracy, adequacy, or completeness of this information, or any reference business operations or advice of others. As we've been saying, we encourage you to consult with your own tax, legal, and financial advisors before engaging in any financial or tax planning activity based on the information provided here. So, thank you all for joining us. As always, you can reach out to us at Sloan Alumni Online at mit.edu. Thanks for joining us today. Thanks again, Jason. We appreciate your time.
Thanks. Thank you.